Okay, so let's get started. So welcome everyone. My name's Adam Mail. I've been a landlord for over a decade. I founded one of the first online estate agents and later a top online letting agent. I'm now with Mashroom, which I believe is the next generation landlord platform. We really are the place to be for landlords. So as I said before, be sure to follow us on Twitter, LinkedIn, Instagram, TikTok, YouTube, and join our private Facebook community, or just come and follow us on Facebook. If you have any questions throughout the webinar, we want this to be really interactive, so please do drop them in the Q&A box and we'll get to as many as we can before the end of the webinar. So today I'm joined by Vanessa Warwick of Property Tribes, another great place for landlords to go. So please do, if you're not a member, please do head over to Property Tribes as well as Mashroom and start interacting on there. A great place for landlords to talk about everything that is landlord related. And we're also joined by Kelly, who is one of our sales team. Kelly spends all of her time at the coalface speaking to landlords, really knows what's in your guys' minds. So Kelly, can you tell us a little bit more about Mashroom and what we can do for everyone, please?
Of course. Hi, everyone. As Adam just introduced me, I'm Kelly. Some of you may recognize my voice. I'm part of the sales team here at Mashroom. So just a little bit about me. I have a background in lettings, property management, and estate agency. I also have a qualification in interior design, so I'm able to offer advice to our landlords on how to make your property more appealing to your prospective tenants. Before we dive in, a little bit about Mashroom and what we do here, because yes, we offer these webinars and all of our website content and our newsletters to keep you all up to date with the latest news and trends, but we also make your landlording life easier and very practical in many ways too. So first up, we help you find a tenant for free. List with us and you get 30 days free on Rightmove and Zoopla. And the way the market is moving at the moment, you'll probably not even need that full 30 days. Everything is very, very fast paced at the minute, which I'm sure Adam can agree. Now, we also support you with your tenancy agreements, organising viewings, everything you need all through our platform. Then on top of that, we also sell everything you need to be a great and most importantly, legally compliant landlord. So all of your gas safety certificates, your EICRs, your EPCs, all of which you can save on our platform. And you get alerts when they're up for expiry, which is another worry off your mind. You can get home emergency insurance and rent guarantee insurance with us at a very, very reasonable price too, as well as your next mortgage, which is actually free with us. So with Mashroom, there's basically no need to stress about anything. We are your one-stop shop for your landlord needs. With that, Vanessa and Adam, over to you.
Brilliant. Thank you very much, Kelly. So let's get on with it. So again, if you've got any questions, please do put them in the Q&A box and we'll get to them as soon as possible. Vanessa and I will be covering trending topics today. So inflation, retirement, and then a bit of head-to-head about interest-only versus repayment mortgages. And I know what I think, I know what I do, but it'd be interesting to see if Vanessa agrees. Hopefully not. That will make for interesting content. So let's start with inflation. The base rate has gone up since the end of last year in attempt to control inflation. Inflation is currently 9% and the target is 2%. We all know the negatives of inflation, higher costs, and pretty much everything from your loaf of bread to your new car costs a lot more money. But how is it affecting landlords and, just as importantly, tenants? Vanessa, what do you think?
Well, yeah, we are certainly entering into a highly inflationary environment, and landlords do need to be aware of this because it is going to impact us on a number of levels. As Adam said, it's currently at 9%, which I believe is something like a 40-year high, and I think it's likely to go up further because of a number of factors, but a big influence is obviously the Ukraine-Russian war, and that's really an outside influence. It's not something that our government can really influence in any way in terms of dealing with inflation caused by that, and also supply chain disruption, which is going to be a part of that as well. And in fact, we've just had a news flash a few hours ago, and I'm just going to quickly read it out. The OECD is warning that UK growth is going to be the worst in the G20 apart from Russia, and that our economic growth is going to ground to a halt in 2023, which is a great concern. With regards to inflation, clearly, as Adam mentioned, it is the base rate. And Adam, we know that this really only affects landlords that are on their lender's standard variable rate. So if you are on that SVR rate, you are going to see your monthly mortgage payment rising, which means that your margin will be slimmed on that property. If you've got a fixed rate coming to an end fairly soon, you need to be thinking about refixing that rate. That's something that Mashroom can help with, isn't it?
Absolutely. So our mortgage advisors can help you refix your rate and get your remortgage in place, which is something that you really should be thinking about. As you said, if you look at your rates and understand if they're coming to an end, and if there's anything you can do, it may be worth calling your provider to see if there's a redemption fee potentially, and do those calculations to understand if it's worth paying. If you've only got 6 months or a year left, is it worth paying your way out of it to refix that rate up for 5 to 7 years? I think it would be prudent to think about that and look at what your risk is, because your costs will change. They will, and they could significantly change. I mean, some properties that I bought, I fixed up for at 6.5%, and I thought that was a great rate at the time, and then everything fell, and it was wonderful when all those fixed rates came off, but now's the time to start thinking about fixing again, and we've had the good times, and hopefully they won't go up too much, but they will go up.
Yeah, I mean, the only way is up, certainly. And the kind of extra sting in the tail is that obviously with Section 24, as a sole trader landlord, your mortgage costs are going to go up, but you can't offset them really against tax. So it's a kind of double sting in the tail. Sorry to be the bearer of bad news there, but we've got to think about inflation from the landlord perspective, because it's going to impact in a number of areas. We've already just said that mortgage rates are likely to go up. I would say they're still quite reasonable, and now is the time to act. If you are going to look at a remortgage, I'm doing 2 at the moment, and I'm personally fixing for 5 years, and I would think that for peace of mind, you should think about 5, and there are actually some quite nice, attractive 7-year fixed rates as well coming out at the moment. So if you are risk averse, you think inflation is going to continue to be a problem, then you should be thinking about fixing for a minimum of 5 years, I would think. But that's a conversation to have with your broker. The other impact, I think, obviously is going to be on tenant affordability. As energy prices rise, fuel prices rise, your shopping basket price rise, all of these things are impacting tenants' pockets and indeed everyone's pockets. But it means that people have less spending on non-essential things. And they start to kind of think much more about their spending and where they're going to spend their money. Clearly, if tenants are struggling with the rising cost of living, it may impact their ability to pay the rent. So we may start to see more arrears. We may start to see tenants looking to maybe move to a less expensive property or a more energy efficient property. And certainly, if you're a landlord that has bills included, so if you're maybe an HMO landlord or a holiday let landlord and bills are included, your margins are probably going to be very, very significantly slimmed, and you do need to think about undertaking some energy saving measures, and this obviously feeds into the whole EPC energy efficiency ratings, which are coming in 2025 anyway. But you might want to think about maybe using having a smart thermostat fitted that you can control. We hear these terrible stories of HMO tenants that have the heating on all day with the windows open. You can't afford to have that happening now in this environment that we're in, with energy prices rising so much. So you might want to fit a smart thermostat. There's a couple of very good ones out there on the market that work very well for landlord and rental properties. And you might want to think about fitting maybe an A-rated boiler. And we are hearing, Adam, that tenants are looking at the energy cost of properties when they're looking to rent. So it is rising up their agenda of what matters to them, isn't it?
Yeah, absolutely. And I think, so I was reading a report about social housing today. The tenants that get, and this is not private landlords, but it's social landlords, but there's some crossover. That's something like 80% of tenants that get into arrears start talking to the landlord when it's too late, and there's no communication. And I think this is where, and I know that you always talk about this as well, good communication with your tenants early on is a must, especially at the moment, because it's tough for landlords, but it's also tough for tenants. These price rises, everywhere you turn, everything just seems to cost a little bit more. And it's impacting, I'm certainly feeling it as well. And it's not just energy bills, it's the doubling in petrol, it's your food, it's everywhere. And your tenants will be feeling that, and yet rents are rising as well, which may or may impact them. So it's worth checking in. It's just worth checking in and making sure that there's no problems before the problems hit. And
I think that's very good advice, Adam. If you do self-manage and you want to get in touch with your tenants, just say, you are aware of the cost of living crisis that we're all facing, and ask how they're doing. I think that's a very laudable thing to do. I think also, Adam, even if you are not including the utilities in your rent, I still think it's a good idea to speak to your tenants about being energy efficient and giving them some guidance on how to save energy, because if they save energy, they're more likely to be able to meet their rental payment obligation. There's a very good website called the Energy Saving Trust, which has loads of resources on it to help people save energy, which we all need to be doing. So maybe, self-managing landlords could direct their tenants to such resources as the Energy Saving Trust, and encourage them and help them to save energy and save on their bills, and that would help them be able to meet their rental payment.
Yeah, I think that's a great idea, and it ties into communication, checking in. That's a good reason to check in. So look, we're just checking everything's all right, and here's some great advice on how you can sort of save on costs and help meet the bills in this tough time, and keep the communication lines open with us. That's just good practice, and it's almost like client service, isn't it? And you'll end up better off for making that effort.
Yeah, absolutely. Jonathan has actually just jumped in with a question and asking about 10-year fixed rates. Yes, I think if you like the thought of knowing your mortgage payment, for the next 10 years, if peace of mind and knowing exactly what your financial obligation is important to you, then yes, I think it's worth considering a 10-year fixed rate. It is quite a long term, I think, if you take into account that some people are saying that inflation will have a soft landing in the next 2 or 3 years. But we do know that one of the only instruments that the Bank of England has to regulate inflation is to raise the base rate. So, there's been lots of discussions in the media about this in recent times. And you know, the only way is up. We've had over a decade of really historically low rates, and they are going to go up. How much, nobody really knows. Some people are saying maybe 3 to 5%, but even that's still fairly historically low. So it really is down to you, your risk profile. If you're exceptionally risk averse, then I would say, yes, you could consider a 10-year fixed rate. But for me, I'm actually opting for 5 at the moment, and that feels right for me.
I suppose it depends how highly leveraged you are as well. So, you know, if you're mortgaged up to the eyeballs, you might want to sleep at night, and also how old you are as well, and what your exit plan is, which is something we'll talk about later. You know, me personally, I would take a 10-year. I have no ambitions at the moment to sell up for the next 10 years. So I would be happy to take a 10-year. So it's really about personal circumstance. And again, that's something that you can discuss with a mortgage advisor, which Mashroom can do.
And I would strongly recommend that. I think that all your professional advisors, to me, they're like partners in my business. I really value their input. I find them a massive support. I've had one letting agent that's been with me since my very first buy-to-let property in 2004. So that's a very long-term relationship. And I also really rate the support of my mortgage broker, who's helped me grow and help me sustain my portfolio over a very long period of time. So yes, these professional people are really, really worth their weight in gold. And you know, you can call up Mashroom and speak to a mortgage broker and get some good advice about what's right for you, because it's so personal to you, Adam. You're absolutely right. It's about your age, your attitude to risk, where you are on your journey. You know, all sorts of things play into it. So you must really get personalised advice. We're going to talk very broad brushstrokes across this webinar today, because we want you to just have a few ideas, a few insights, and then take those forwards with a professional advisor. I
run my advisors, and they know so much, and it's incredible the depth of their knowledge, and they know far more than I could know about this stuff.
Oh yeah, that's what they're there for. And you know, mortgage
access to these obscure lenders that I've never heard of.
Yeah, there's loads of new lenders coming into the market, and you know, they have all sorts of different products, and it's still fairly competitive. So that's why now is a very, very good time to act. Let's talk about some of the positive aspects of inflation, because actually inflation is not totally negative. Basically, inflation, at around say 2 to 4% is actually healthy for the economy, because it means that the economy is working at the maximum efficiency and productiveness. So inflation isn't all bad. And from a landlord perspective, I think one of the key things for me is that inflation erodes debt. And that's a very comforting thought, because over time, as inflation rises, essentially what it means is that the money that you used to acquire your property, if you track forwards, the money that you use to repay that loan is worth a lot less than the money that you acquired the property with. So it's very, very true phenomenon that inflation does erode debt over time. I think the other interesting thing to note is that during a very inflationary environment, which we are most certainly in and going to stay in for the foreseeable future, is that people put off big financial decisions during these kind of uncertain times, and therefore they look to rent rather than buy. And this, of course, plays into what we're hearing about rental demand. I mean, it's gone through the roof, Adam. We are hearing of, landlords leaving the sector in droves. There's been so much media commentary in the BBC about the shortage of landlords and how that is pushing up rents. I've actually got a little personal anecdote from this week. I had a one-bed flat in London N5 come up for rent this week. My agent put it on the portals and he had 107 inquiries in 48 hours. He whittled that down to 17 viewings. All 17 turned up yesterday, which is quite amazing as well.
That's amazing. I've never had that.
And I've had 4 offers today, and 2 of them are £100 above the asking price. And I'd already put the rent up by £100 more than the outgoing tenant was paying. So that's just a little anecdotal insight that tenant demand is just going through the roof, and rents are going to be part of this inflationary environment because they are going up, and we're still seeing house prices going up. I mean, it's absolutely astonishing, how powerful the property market is, and it's been very resilient and robust, but it can't carry on like this. So I think we all have to be prepared that there will be some kind of correction. I'm not going to say crash, because I think crash is far too emotive word, and you're talking about 30% drop in prices. I think we will see a little bit of correction, but of course, Adam, as we've said before, the property market in the UK is just not an average market. It's right down to a street level to a micro level. So, one street could be really robust and prices could continue to go up a little bit, and then another street across the other side of town could be really badly affected and start to drop. So, you can't really say anything average about what's going on in today's property market.
Yeah, and we're seeing some of the suburbs of London really going through the roof as well. And I think that's driven by the fact that people don't necessarily need to live in London anymore. So they're happy. If you only need to go into London once a week, then why do you need to live in London? So you can have something a bit bigger outside of London, but that's driving the prices up outside London. I'm certainly seeing that in Kent, where I live. It's definitely they're going up and up. But you're right, there will be a correction, but that doesn't have to be. And the media will talk about a crash. The media will talk about house prices. They'll see one bad month and it will be a crash. But it's historically it's never that bad. It feels bad in the moment, but we are an island and there's only so many houses on this island, and it generally mid to long term, the UK housing market, I'm a believer in it.
Yeah, well, 100%. In fact, I was on a webinar this morning about the London property market, and a letting agent who's got a very big footprint in London was saying that demand for 1 or 2 bed flats is actually really going through the roof, because people are wanting them either to buy or rent as a pied-à-terre, because they are coming into London a couple of days a week, and we do see this more hybrid model of partially working from home, partially working from an office. We do see that kind of starting to embed somewhat. In fact, one of the directors of Rightmove was on the same call, and he said that Rightmove employees are only required to go into the office 2 days a week now, on a Tuesday and a Wednesday. So I think, flats are going to continue to do very well. We all know that 1 bed flats are just entry level into the market. They're the cheapest accommodation option, really, apart from if you rent a room. So I think all the indicators are very positive in terms of certainly rental demand, and certainly rents being sustainable, largely because so many landlords are leaving the sector. And I think this environment that we're in now, this very inflationary environment, there may be some landlords that were thinking of maybe exiting in 5 years' time, and they've just brought their decision forward by 5 years, because they just don't want to be in these very challenging market conditions.
Well, that kind of brings us on nicely to the next sort of topic, which is retirement. So lots of landlords invested property for their future, and there's a few retirement options available. Obviously, we're not tax advisors, so we're not going to go into depth about tax issues and setup. We're just going to talk very generically, but there's certainly lots to think about with retirement. I take myself as an example. I bought property for my retirement to have in conjunction with a normal pension, so I've kind of spread the risk. So the income doesn't worry me in the interim, as long as it sort of wipes its face. What I do when it comes to that time, whether they're performing well enough to live off the rents, or whether I want to sort of dispose of everything and take the lump sum value of the property, I haven't decided yet. That'll be a decision for when that day comes. But yeah, what's your thoughts on exit strategies?
Well, it's kind of been a bit of a trending topic on Property Tribes the last few weeks, which is why I suggested it for today. You know, I think it is on landlords' minds. As we mentioned, some landlords may be thinking of exiting earlier. Actually, I was just going to jump in and say that Siobhan has asked, why are so many landlords leaving the sector if rents are so good? Well, the simple answer, Siobhan, is that there's so much increasing regulation, legislation and taxation that, you know, a lot of landlords have just had enough, and the margins are too slim for them to take the risk of renting out to a tenant who may damage the property or may not pay the rent. And I think the other actual thing to mention about inflation is that it's because we've got increasing wages as well, a lot of people are going to be pushed into a higher rate tax bracket. So if you're a landlord with a job and you're pushed into a higher rate tax bracket through inflationary wage rises, then that's going to impact your tax position even more. So there's so many different facets to this, and I do appreciate it can be quite mind-boggling to try and join up all the dots, really. But you know, I think for my part, when I got started, I had 2 or 3 potential ways to exit my portfolio. And I think it's really, really important that when you start out on your property investment journey, that you actually start with the end in mind. Because when you exit a property portfolio, you will have some quite significant tax liability, you know, such taxes as capital gains and inheritance taxes, and so on. So you really do need to think about structuring your tax business in the most efficient manner, depending on how you're going to exit. And in fact, I believe Mashroom's got quite a few webinars on this topic, haven't you, Adam, in terms of tax structures? Because again, it's highly, highly personal to the individual and what they want their portfolio to achieve for them.
And it's, you know, you need to get good advice, and that's really, really important. And actually, if you join mashroom.com, you'll see in your dashboard there's a lot of tax webinars. We have tax advisors that talk about the structures and about the options that are available to you, and it's a very, very personal thing that you need to think about, and there's lots of factors. It's easier if you're starting out and you can get it right from the outset. If you're like me, and I suppose I've been subject to rule changes as well, so I'm going through a period of having to restructure the way I structure everything with the future in mind. But I needed a lot of advice in order to get the right solution for myself. So it's really important to get that really good advice, because if you get it wrong, it can be fairly catastrophic. So the tax side is one part, but as you said, a lot of people are getting out because they just can't cope with all the changing legislation, and I think that's actually a shame, because I think although it can feel overwhelming, I think to take time to understand it and utilize platforms like Mashroom and to spend the time coming to webinars like this, and obviously anyone who is here is one of those people, so I'm preaching to the converted. Actually, a lot of the legislation isn't as bad to cut through as possible, and it's just about ticking more boxes and making sure that you're on top of a few more things. And so I think it's a shame for people to get out for that reason, to be honest, because I think once you start sort of making the effort to navigate your way through it and potentially use platforms like Mashroom, it's not as bad as it all seems.
Well, I would agree with you. And also, you know, in an inflationary environment, assets like property are one of the things that fare the best. If you've got an income producing asset that you're managed well, you will come through this, and you will still be strong. So I think, as we keep saying, and we'll keep on saying, this is why education is so important, because it is going to be the educated and informed landlord who is going to survive and thrive. And there's opportunity in any market conditions if you choose to look for the angle and get the right advice. So, there's let's talk about a few different ways to exit. One school of thought is to just sell one property per year as you approach your retirement. This is good, I think, from the perspective of you can look at the least performing properties, the worst performing properties in your portfolio, and you can kind of prioritize them as to which one to sell off first, because obviously you want to sell the worst performing property first. If you just sell one property annually, you can benefit from the 12,300 tax-free allowance for capital gain. So that's one thing that you can do, is look at your portfolio. I believe on Mashroom there are some metrics to help you understand your property portfolio's performance, and then you can make a little list of which order you want to sell the properties in, keeping the best performers till last. A second option is probably what I've got a couple of choices actually. A second option is to sell off half of your portfolio, pay off all those mortgages, pay your capital gains liability, and use what's left over to pay off the mortgages on the other half of your portfolio. So you end up with a set of properties that are unencumbered, that don't have a mortgage on them. And if you've been in the game a very long time and you haven't over leveraged during that period and constantly kept remortgaging, then you should have enough equity in order to be able to pay off quite a large chunk of your best performing properties and just keep them as unencumbered for income.
That's a great idea, because you get the best of both worlds, don't you?
Yeah.
You get the it's like a sort of a standard. It's like when you worked at a company for 30 years and you get a hit of a lump sum and then a pension, and that's what you're kind of replicating in that model. So that's quite a nice idea, isn't it? If you've got a portfolio that can sustain that.
Yeah, and you can combine the two that we've talked about already, which is selling off one per year to benefit from the maximum tax-free allowance for your capital gain, and then, as we said, pay off the other half of the portfolio with the proceeds from those sales. There's a third thing you could do, and that is you could have another investment that's going to pay out. My husband and I invest in fintech, and our investments have done extremely well, and our shareholding is now worth more than all the mortgages on our properties. So we're sitting quite comfortably there. Should we decide to cash in our shareholding on this fintech company, then that would be a way to pay off our mortgages. Some people rely on inheritance. I don't think it's a good idea to rely on somebody passing away, although obviously it does happen, of course. Other people want to leave their properties as a legacy to their children. There are tax efficient ways that you can pass your properties over to your children while you're still alive. Obviously your children have got to have an interest in it and want to be involved. Some people have big savings that they just keep back to pay everything off. I think the other thing is that nowadays there are buy-to-let mortgages up to the age of 100. So actually you could remortgage and go for another long-term mortgage. I'm 60 this year and I've just been offered a 25-year term remortgage. So, there's still long-term to think. And to be honest, if you haven't got anybody that you want to benefit from all your hard work, why not just die in massive debt? that's the end of the problem. Your estate will deal with it. You can actually leave your property equity to a charity, and there's very minimal taxes on that. So you know, there's loads of different things you can do, and I think it's good and healthy to explore the different options. And you, every year you'll almost certainly get a letter from your lender saying, are you aware you're on an interest-only mortgage?
Yeah.
You haven't been repaying it down. What plans do you have in your you know, in your future, where you're going to be able to redeem this mortgage when the term ends? And you need to be able to answer that question. And you might have 2 or 3 options like me, and that's good. So explore those options and think of which is going to work best for you, and certainly get again tax advice if you want to leave properties as a legacy for your children, or you want to pass them over to your children before you shuffle off your perch.
Look, Margaret's asking, I'm just selling up earlier than I was going to. What are the benefits if you sell and go into a limited company? It's not something we're going to get into on this webinar. If you go, if you sign up to Mashroom, there'll be a webinar from one of our tax advisors that I think it was the last one that could talk about going into a limited company. There is lots of good things, but also lots of expensive things to transfer your properties into a limited company, such as stamp duty and capital gains. So there could be lots of and it could be personal to your situation as well. So definitely worth looking into, but it may not work for you.
Indeed. And I guess that kind of nicely leads on to, we were going to do one of our head-to-heads, Adam, weren't we? Because a very frequently asked question on Property Tribes is, should I go for an interest-only mortgage or a capital repayment mortgage? Now, clearly, if you have a capital repayment mortgage at the end of the mortgage term, you will have no mortgage left on your property. So there's something to be said for that. But I'm sure Adam will agree that the vast majority of buy-to-let investors go for an interest-only mortgage. And Adam, you know, it does crop up a lot, you know, interest only or repayment. What's your view?
So before you guys get into that, I just want to remind everyone here that we also offer mortgages. Working with us, whether you're a first-time buyer looking for a buy-to-let or a remortgage, is completely free. So usually you pay for your mortgage broker a fee, something like £500 to £700, which is a lot of money anyway, but especially at the time when you're spending thousands already. But we take our fee from the lender, and we have access to over 90 lenders and for more than 12,000 mortgage products as well. So not only can we save you money, we can also help you find the right deal for you too. So if you're thinking about investing anytime soon, definitely get in touch with us. Sorry, Adam, over to you.
No, that's right. So, and that's good advice, Kelly. I use our advisors myself, so it is really good advice. So interest only or repayment. When I started out, I put everything on repayment and paid down as much as I could in those early days, and then when COVID hit, I put everything. The first thing I did when sort of the news was hitting that there was going to be problems with the pandemic, I put everything on interest only, just because cash is king, isn't it? So just to make sure that I was going to be as safe as possible, and I haven't changed that since, really. And actually, my properties are all sort of 10, 12 years into me owning them now. And this is a good bit of advice for newer landlords, is that the maintenance costs, you know, when you get to that sort of 5 to 10 year period, it really starts racking up, especially if you've got, most of mine are Victorian conversion flats in London. So you're talking about renovating sash windows and repainting and things like that. It doesn't come cheap. And those costs start mounting up. Boilers, new boilers, you know, that's another one. And I had sort of 3 boilers go at once, and that hurt.
Ouchie.
Exactly. So when they get a little bit older, you really have to account for that, and it's worth thinking about that when you're doing your calculations. And we all do these great spreadsheets that look fantastic, but it's worth really taking into account those maintenance costs, the redecoration costs. Tenants don't want to live in a flat that looks like it hasn't been touched for 10 years. So you've got to think about redecoration costs. You've got to think about new kitchens, new appliances. Again, the tenants don't want to use kitchen appliances that look like they're from 1985, or bathrooms that with old fittings. It's really important to factor in those maintenance costs.
Yeah, no, I totally agree. I think, we said that the vast majority of landlords do go for interest only. I think there's a few key reasons for this. First of all, if you have an interest only mortgage, the monthly payment is significantly less. So your cash flow month on month, your net cash flow month on month is a lot more than if you had a repayment mortgage. And bearing in mind that property is a very long-term investment, cash flow is king. It should always be your first consideration, because if you don't have month on month cash flow, then you might not survive in the game long enough to benefit from all that lovely capital growth. Obviously, if you have very significant other income and you're not relying on property as an income, then you could take a view on that, and you could just say, well, okay, I'm not reliant on the income from the rental properties. They're just there on the back burner as a pension hedge or whatever. So I will go for a repayment mortgage. And that's, your choice. As we keep saying, it's personal to you. The second reason that landlords go for interest only is that most mortgages, you'll find that they have a clause in them where you can pay off up to 10% of the capital per annum. So you should think about that, because it's a really useful facility to have. If you've got an interest only mortgage but you want to pay down some of the capital, you can actually choose to overpay by up to 10%. Maybe 10% is too rich for you for one year, and you only want to overpay by 5%. You can be very flexible in how you pay down the capital on that interest only mortgage. And to my mind, that's actually better than having a very structured repayment mortgage, which you can't make decisions on of that nature. I think the other thing is that the way mortgage payments are calculated, there's a little graph you can find which really explains it graphically better than probably I'll explain it. But essentially, for the first 10 years of any mortgage term, you're only paying down the interest. So you're not actually biting into the capital at all. So for the first 10 years, you've got a much larger monthly mortgage payment, but you're not actually paying into the capital debt. So there's a lot to be said for interest only, provided that you do have an exit plan, as we've just discussed in the previous segment. Adam, I'm quite in favour of perhaps choosing one property and just focus on that one to pay down the debt on that one. Having an unencumbered property is actually a very useful tool to have. You can bridge against it, for instance. So it's quite a nice little thing to have in your portfolio, a bit of risk mitigation. Maybe you could just choose the property that's got the highest or mortgage rate, or that you feel is the most susceptible or the most vulnerable, and just really focus on paying that one property down. I think
that's a great idea. I think in anything that we do, and in any business, and we are a business, and that's really important to remember, that you, even if you've got one property, think of it as a business, and you'll do a lot better. Is flexibility, and the biggest reason for any business to fail is cash flow. Mm-hmm. And if you keep that flexibility of cash flow, and that doesn't mean you can't keep repaying. As you said, if you've got this option of repaying 10% a year, then keep that control. It's about keeping control. Mm. And if you've got one asset that's paid down, you've just got more control. And if you've got control of your cash and control of your assets, then you're more likely to succeed.
Yeah, I totally agree. I think, when you start out, it can all seem quite overwhelming. I know when I started out seriously in 2004, I was so nervous about taking on mortgage debt, and the thought of just paying the interest only really did frighten me at first. But I think it's important to understand that one of the most wonderful benefits of buy-to-let is leverage. And using debt in a very positive manner, because you're using a smaller amount of your own capital, your deposit, your maybe 25% deposit, you're using that to control a very large asset that somebody else has funded to the tune of 75%. So, I think it's really important to understand that mortgage debt is actually very, very healthy debt if you're managing it correctly. And obviously, if your properties go up in value over time, you're getting two bites of the cherry. You're getting the cash flow month on month from the rent, and you're getting the appreciation rising. And indeed, we've got forced appreciation, which is when you refurbish or develop a property and force the appreciation through those methods, rather than just waiting for capital growth. And this goes back to the whole issue of a property crash. If there is a price correction, you can still, sorry, that was my phone. If there is a price correction, you can still force the appreciation through refurbishment or development. I mean, all of these things are just reminding me what I love about property.
Yeah, and again, coming back to the price crash, if there is a crash, as the media would call it, if you've got good control of your assets, if you've got good control of your cash flow, you can simply sit it out and switch off all the noise of the media telling you that property is finished, property's done for in the UK, which is what the headlines will say. It's my opinion, and it is only my opinion, is that it's just peaks and troughs of a graph that generally goes in one direction, but it doesn't go up, it doesn't go straight up, it just peaks and troughs.
Yeah, and you're not selling anything when there's a slight price correction. We've had so many capital growth gains in the last couple of years that it's going to take a lot to even erode those. But if you're not selling anything, as Adam says, just sit it out. And I think that's such good advice, Adam, not to read the mainstream media. Let's be clear here. They are competing for eyeballs.
Yeah,
they're all desperate for eyeballs, and they will say anything to get a click. And quite often I see something that's specific to Wales or something, the Welsh PRS, but it doesn't actually say that in the headline. So you get this really ominous headline, and then you click on it, and it's actually to do with the Welsh PRS. And we do get all this doom and gloom and really emotive rhetoric. And don't read it. I'll be honest with you, I haven't watched television for about 4 years now. I get all of my inputs from the web and from trusted sources on the web. And my mental health is so much better for not reading all this doom and gloom, because it's simply there to grab an eyeball. And the worse and more scary they can make it, the better. So don't take any notice.
It's all about clicks and selling papers, and and as I said, it's never usually as bad as it makes out in terms of the housing market, at least. And what it does is it causes panic, and then people start selling, which causes a bit more of a downturn. So the downturn's always exaggerated, and then people come in and start buying, and it all comes back to, it levels out again. It's very much like a slower version of a share price.
It is. And I think, when you look back, you'll see, as Adam said, that it is a little bit like a roller coaster. During the last financial crash, I did have a few properties that did struggle or did reduce in value. From that, I learned the lesson that quality is king, because quality properties in good areas, I believe, are more robust in areas where there is wealth, where there's employment, where there's money, where there's regeneration, where there's infrastructure. All of these things really help keep house prices robust. But I went through the 2008 financial crash, and all my properties, have all gone up in value. Some more than others. All my stuff in London and the southeast and my holiday lets have done extremely well. My stuff in the north of England, not so great. But again, it's a long-term thing. If you're not selling, if you've got your cash flow happening, your net month-on-month cash flow, that is absolute king. It will help you survive through any market downturns. And when we come out the other side, things become much more healthy, and we're glad that we kept the faith with property, and they've always served me well, I have to say, Adam.
And how are the yields in the north? Are they better? Do you get better yields on the rent in the north?
Well, surprisingly, no. I've got stuff in Manchester and Leeds, and they've not done well at all, capital appreciation wise, and I've had kind of a bit more of tenant turnover. Not so good quality tenants. That could be just down to the letting agent I used. And I think, when we talked about the team that you have around you, the letting agent is vital for you if that's the way you want to go. It is interesting. I think a good example of capital appreciation was this one bed flat I've just had 107 inquiries for. I paid 147,500 for that in 2004, and I've just had it revalued at 340,000. So it's done extremely well, and
that's not an unusual story, is it? That's not an unusual story, especially in London. But it's just patience, really. I think there was a time in property where you could, there was a lot of property shows on telly, and there was a perception that you could make money very, very quickly. And you still see these YouTube sort of make millions very quickly videos, and you still see them about, and it's not, I'm sure it's possible, but generally it's not. And it's a business, and like any business, it takes time. And if you run it properly, you think about all the right things, the cash flow, the legislation, how to document things, how to do things correctly, then you should be fine.
We should be. Let's talk about what's guaranteed in property. I think that would be a good way to wrap this up, because there are few things that can be guaranteed in property. One thing that is 100% guaranteed is that time is going to pass.
Yeah.
Time is generally very favourable to owning property. As we keep saying, it is a long-term investment, and over the fullness of time, your property is likely to go up in value, and your debt is being eroded by inflation at a very quick rate as we speak. So we're absolutely guaranteed that time is going to pass, and you will look back in 20 years and say, I wish I'd bought more, because that's what everybody says. That's what I say.
You hear the story, everyone's got the story about, I sold this property 10 years and today it would have been worth.
Exactly. So I've got deals that I wish I'd bought more. As you know, I bought mainly new build, and there's, I've got a house in High Wycombe. I paid 330 for that, and that's been revalued recently at 550. So that I wish I'd bought 3 of them. But being risk averse at the time, I didn't. A friend of mine has a very good saying. He says, "Go big or go home." And I think that's interesting, because I think I've been quite I have been a very risk averse investor.
It's not a bad thing. It's not a bad thing.
Yeah, I think if you've got the understanding of your business, and you've got everything in place, your finance and everything, then there's so much opportunity out there. Let's talk about what else can you can guarantee. Well, I think that rent guarantee insurance is a very good product to have. It protects you from a delinquent tenant, and we're hearing because of this huge tenant demand that tenants are struggling to move on from a property. So when the landlord has, perhaps said, I want to sell up or whatever, the tenant's saying, but I can't find anywhere else to rent. I'm going to have to stop here. So I think going forwards, also, as we've mentioned, with tenant affordability issues perhaps coming to bite, I think rent guarantee insurance is a bit of a no-brainer.
I think it's a must. I think cost of living, your tenants are going to struggle more. They may have issues paying the rent. That we're going to see arrears go up with the cost of living. It's going to happen. So rent guarantee insurance is a must. Also, we've got the Section 21 going, which means that you really, really do want the legal backup of having those legal costs covered and your rent covered, because it simply will take longer to get a tenant to remove a tenant if you have to go down the unfortunate eviction route without that Section 21 in your back pocket. So I think it's a real, and there's a lot of landlords that don't buy it, and I admit that once upon a time I was one of those landlords, and I got burnt. I got burnt through COVID, where I was sitting there wishing that I had rent guarantee insurance on one particular property. The money I lost on that one property would have paid for all the rent guarantee insurance that I ever need on the whole portfolio. So it's something that I get going forward. You never know what's around the corner, and I think it's really important.
Yeah, RGI is one of our top selling products, and of course we highly recommend it to all of our landlords. Should any of you watching wish to book in a Q&A with me, you are more than welcome to. I host landlord consultations for this very reason, so just arrange that call with me and I can help you. Yeah,
or you can put if you put your email address in the chat, then people can just reach out to you directly, Kelly.
Great.
About rent guarantee. So we've got a great product which really does cover all bases. So great. Well, Vanessa, fascinating, great conversation as usual. Thank you very much for joining us today. A nice ending comment from Margaret. I went to the course and the key statement in the course was cash flow, cash flow, cash flow. I think Vanessa's idea of paying down one property is a great idea. It certainly worked for me. So that's a nice one.
Good to know, Margaret. Thank you. Really interesting, because we'll have very experienced landlords on this webinar as well as newbies, and we really do value your engagement and you asking questions, and this conversation doesn't have to stop now, because this video will be posted on the Mashroom community Facebook group, and I've been on there myself lately, and I've been answering a few questions and trying to help direct people to resources and whatnot. So I do recommend everybody to join the Mashroom Facebook community, jump across there, and we can continue chatting on the Facebook group. I mean, that's what's it's so brilliant about social media. When I started out in 2004, we just didn't have these kind of free resources, so everybody should take advantage of them.
It's a great place. There's great chat going on in the community all the time. Join Mashroom as well. You've got lots of free tools, free Rightmove and Zoopla advertising, so you can take control of your portfolio, free landlord tax tools where you can track your expenses, and documentation storage as well. So there's just loads of great stuff. So thank you very much for joining us. We are back on the 17th of June at 3 p.m. We've got HMRC joining us. So
I think that's awesome.
I think it's brilliant. We've been trying to get them to come onto a webinar for a long time. So please do come on. It's going to be a bit of an extended one. We're going on to an hour and a half, because they've got a presentation they want to give. And then we're going to open up the floor to questions, and I'm sure there will be a few. So please do join us. I think that's going to be a fascinating one. But for now, we really appreciate you coming to the webinar. Thank you very much, and good night. Have a great night.
Yeah. Thank you for joining us, everybody. I'm saying good night as well. Anybody wants to catch me, I'm on Twitter at @4_walls. I'm on the Mashroom community Facebook group, and also, of course, I'm on Property Tribes from morning, noon and night. So I look forward to seeing you around the social web, but bye-bye from me.
Thank you, guys.
Bye.